If you've always assumed Social Security is simply tax-free income, I need to correct that right now, because for a large number of retirees, it isn't. And if you've heard the number 85% floating around in connection with this topic and assumed that means losing 85% of your check to taxes, I need to correct that too, because that's not what it means either. Today, I'm going to walk you through exactly how Social Security taxation actually works, the specific income levels where it kicks in, and a detail about those income levels that honestly surprises most people once they hear it. This is a topic that tends to get oversimplified in both directions. Some people assume their benefits are completely off limits to the IRS, full stop, no exceptions. Others hear secondhand that Social Security gets taxed at 85% and walk away thinking they're about to lose the vast majority of their monthly check the moment they file taxes. Neither version is accurate, and the actual rule sits somewhere more nuanced and, honestly, more manageable than either extreme suggests. If you're not subscribed yet, take a moment and do that now, and turn on the bell. This is one of the most misunderstood parts of the entire Social Security system, partly because the math involves a formula most people have never seen explained in plain language. That's what this channel is for. Subscribe, and let's get into it. Let's start with the core myth I need to clear up. Social Security retirement, survivor, and disability benefits are not automatically exempt from federal income tax. Whether any portion of your benefit gets taxed depends entirely on something called your combined income, sometimes also called provisional income. This is a specific calculation, not just your regular income, so let's walk through exactly how it's built. Your combined income equals your adjusted gross income, not counting Social Security itself, plus any tax-exempt interest you received, plus half of your total Social Security benefits for the year. That's the formula. Take your other income, add any tax-exempt interest, add half your Social Security benefit, and that total is the number that actually matters for this calculation. Once you have that combined income figure, it gets compared against specific thresholds that depend on your filing status, and those thresholds determine which of three tiers you land in. If you file as a single person and your combined income is below $25,000, none of your Social Security benefit is taxable. If your combined income falls between $25,000 and $34,000, up to 50% of your benefit can become taxable. And if your combined income is above $34,000, up to 85% of your benefit can become taxable. If you're married and filing jointly, the same three tiers apply, but with higher thresholds. Below $32,000 in combined income, nothing is taxable. Between $32,000 and $44,000, up to 50% can be taxable. Above $44,000, up to 85% can be taxable. Let me walk through a simple example to make this concrete. Say you're single, your other income for the year totals $20,000, and you receive $20,000 in Social Security benefits. Half of that benefit is $10,000. Add that to your $20,000 in other income, and your combined income comes out to $30,000. That places you squarely in the middle tier, between $25,000 and $34,000, meaning up to 50% of your Social Security benefit could be includable in your taxable income, not the full 85%, and certainly not all of it. Let me also show you what the higher tier looks like with a second example, this time for a married couple filing jointly. Say their combined Social Security benefits for the year total $40,000, and they have an additional $50,000 in other income from a pension and some investment withdrawals. Half of their Social Security benefit is $20,000. Add that to their $50,000 in other income, and their combined income comes out to $70,000, well above the $44,000 upper threshold for joint filers. In a case like this, the actual taxable portion of their Social Security benefit, calculated using the full IRS worksheet rather than just the percentage ceiling, comes out to around $28,000, which works out to about 70% of their total benefit being included in taxable income for that year. Even in a case like this, well above the upper threshold, the number stays under the 85% ceiling, because the actual calculation depends on exactly how far above the threshold your income sits, not simply on which tier you're in. Now, I want to spend real time on the part that confuses almost everyone, because it's the single biggest misunderstanding in this entire topic. When you're in the 85% tier, that does not mean 85% of your Social Security benefit gets taken away as tax. It means up to 85% of your benefit gets added into your taxable income, and then that combined taxable income gets taxed at your normal income tax rate, whatever bracket that happens to be. Here's a concrete way to see the difference. If you're in the 85% tier and your ordinary federal tax rate is 22%, your actual effective tax rate on your Social Security benefit itself works out to roughly 85% multiplied by 22%, which is about 18.7%. That's a real cost, but it's dramatically different from losing 85% of your check, which is what a lot of people picture when they hear that number for the first time. The 85% is a ceiling on how much of your benefit can be exposed to taxation, not a tax rate applied directly to your check. Here's a detail that I think deserves real attention because it explains why this issue keeps getting worse for more retirees every single year, even though nothing about the law itself has changed recently. Those income thresholds I just walked through, $25,000 and $34,000 for single filers, $32,000 and $44,000 for joint filers, have never been adjusted for inflation. The lower thresholds were set back in 1984. The upper thresholds, the ones that introduced the 85% tier, were set in 1993. Every other part of the tax code you're familiar with, your tax brackets, your standard deduction, gets adjusted upward most years to keep pace with inflation. These specific thresholds never have been. That means as wages, pensions, and Social Security benefits themselves have grown over the past 3 to 4 decades, more and more retirees have been pulled into taxation on their benefits, not because Congress changed anything, but simply because the unchanged thresholds cover less and less purchasing power every year that passes. There's a specific trap inside this formula that catches people who think they're being financially savvy. If you hold municipal bonds specifically because the interest is tax-exempt, that strategy works fine for your regular income tax return. But that same tax-exempt interest still gets added into your combined income calculation for Social Security taxation purposes. In other words, tax-exempt interest is not exempt from this particular test, even though it's exempt from regular income tax. This is one of the only places in the entire tax code where income that's otherwise tax-free still counts against you for a different calculation. I also want to flag a filing status that creates a particularly harsh outcome. If you're married, but you file your tax returns separately rather than jointly, and you lived with your spouse at any point during the year, the rules change dramatically in an unfavorable direction. In that specific situation, your threshold for the 85% tier effectively drops to 0, meaning up to 85% of your benefit can be taxable starting from your very first dollar of combined income, with no lower tier and no tax-free zone at all. This filing status should generally be avoided for Social Security recipients, unless there's a specific, compelling reason unrelated to this particular issue that makes it necessary. Now let's talk about something genuinely new and relevant, because it connects directly to changes I've covered elsewhere on this channel. A tax law passed last year introduced what's sometimes called the senior bonus deduction, an additional deduction of $6,000 for an individual or $12,000 for a married couple, available to filers who are 65 or older, running through 2028. This deduction reduces your adjusted gross income, which is the starting point of the combined income formula. For a lot of lower and middle income retirees, this additional deduction can be enough to push their combined income back below the relevant threshold, reducing or even eliminating Social Security taxation that would otherwise have applied. I mentioned this same piece of legislation in another video on this channel, in the context of how it affected Social Security's broader trust fund revenue projections. This is the other side of that same policy. the direct, personal tax benefit it can provide to individual retirees, separate from its larger effect on the program's overall finances. I want to briefly cover state taxes too, because federal taxation is only part of the picture. The good news here is straightforward. The large majority of states do not tax Social Security benefits at all. As of this year, only 9 states still tax benefits in any form, and most of those states offer their own income-based exemptions that shield many retirees even within those states. A few states have recently eliminated this tax entirely, joining the much larger group that never taxed Social Security benefits in the first place. If you're unsure whether your specific state taxes benefits, it's worth a direct check with your state's Department of Revenue, since this changes periodically as state legislatures revisit the issue. There's also a piece of pending federal legislation worth knowing about, called the You Earned It, You Keep It Act, which would eliminate federal taxation of Social Security benefits entirely if it became law. As of right now, this bill has not passed, and current law continues to apply exactly as I've described throughout this video. I'm mentioning it the same way I've mentioned other pending legislation on this channel, as something worth being aware of, not something to plan around as though it's already decided. Let me answer a couple of related questions before we wrap up. Does any of this apply to Supplemental Security Income, or SSI? No. SSI is a needs-based program with its own separate income limits for eligibility, and it is never subject to federal income tax, regardless of your other income. This entire combined income calculation applies specifically to Social Security retirement, survivor, and disability benefits, not SSI. Does the calculation work any differently for survivor or disability benefits compared to retirement benefits? No, the formula and the thresholds are identical across retirement, survivor, and disability benefits. Whichever type of Social Security benefit you receive, the same combined income test, the same 3 tiers, and the same thresholds apply equally. So here's what I want you to actually do with this information. First, calculate your own combined income using the formula I gave you. Your other income, excluding Social Security, plus any tax-exempt interest, plus half your total Social Security benefit for the year. Compare that number against the threshold for your filing status to see which tier you fall into. Second, if you're close to one of these thresholds, be aware that additional income, an IRA withdrawal, part-time work, even municipal bond interest can push you into a higher tier, sometimes increasing your tax burden by more than the extra income itself would suggest, since it simultaneously increases both your regular taxable income and the portion of your Social Security benefit that becomes taxable. Third, if you're 65 or older, make sure you're actually claiming the new senior bonus deduction on your return, since it directly reduces the income figure that determines whether your benefits get taxed at all. Fourth, consider the timing of larger taxable withdrawals from retirement accounts. Spreading withdrawals across multiple years, rather than taking one large distribution in a single year, can help keep your combined income from spiking into a higher tier in any single tax year. Fifth, check your specific state's treatment of Social Security benefits directly, rather than assuming based on what you've heard generally, since state rules vary and change periodically. Here's the honest full picture, one more time. Social Security benefits are not automatically tax-free. Whether they're taxed depends on your combined income, your adjusted gross income, plus tax-exempt interest, plus half your benefits, compared against thresholds that have remained frozen since 1984 and 1993. Up to 50% of your benefit can be taxable in the middle tier, and up to 85% in the top tier. But that 85% is a ceiling on how much of your benefit counts as taxable income, not a tax rate applied directly to your check. A new senior deduction can help offset this for many retirees, and most states don't tax these benefits at all, even when the federal government does. If you know someone who's been surprised by taxes on their Social Security benefits, or who's been avoiding finding out because they assumed the worst, send them this video. Understanding the actual mechanics here usually turns out to be a lot less frightening than the 85% number sounds on its own. A few minutes spent running the actual formula, rather than going off the headline percentage, tends to replace a vague, anxious guess with a specific, manageable number. That's what this channel is here for. I'll see you in the next one.